If you're a property investor or if you're in business, you're probably going to be reveling in the low interest rates around at the moment, and they're likely to get lower over the next year or so. In fact, they're likely to remain low for a decade or even more. But what does this really mean for property investors? What are the implications for property and for other asset classes, for investors in general? What's it going to mean for your returns? What can you look forward to? And how do you have to invest differently in the coming decade as opposed to in the past, considering we're in a lower wages growth, lower inflation, lower interest rate environment? All very important questions if you want to become a successful property investor. And that's what I discussed today with Pete Wargent in this episode of the Michael Yardney podcast. Lots of great information in a prolonged interview. But before we run that particular chat, I'm going to share with you my mindset moment. And it's about where are you going to be in 10 years' time? It's a lesson I learned from one of my mentors, and I hope I can pass the message forward to you to help you plan your future to make sure you get the most out of your life. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
Many years ago, my mentor, the late Jim Rohn, asked me a particularly good question. And so I'm going to ask it to you. Where do you see yourself in 10 years? That's a good question. Where are you going? Because 10 years from now, surely you're going to arrive. But the question is, where? So Jim Rohn taught me we don't want to kid ourselves about where. We don't want to kid ourselves about the road that we're walking. He said at the age of 25, shortly after meeting his mentor then, Earl Shoaff, he had a day that he called Do Not Kid Myself Anymore Day. Jim Rohn said, I didn't want to be disillusioned anymore. He said, I finally decided that the crossed finger theory wasn't going to get me where I wanted. I realised it wasn't. That's where the treasure lies. I was going to have to make sure which way I was headed. Jim Rohn said, then, with Mr. Shoaff's help, I found a few reading disciplines, a few disciplines of the mind and a few disciplines of activities. When exercised, he found that all these disciplines make a difference to the world. It makes a difference to where you're going to arrive. But it took a few changes. Sometimes we get the idea that we're doing 10% and there's 90% more that you need to do to make a difference to your life, to your fortune, to where you're heading. But most likely it's the opposite that is true. We're probably doing enough things to have bought and shared into the good life. But maybe we still need to do an extra, 5%, 10% of intellectual activity, of activity change, of refinement of discipline, of refinement of the thoughts. And all we need is the ideas to make those simple changes, and the equity starts gathering in 1 year, 3 year, 5 years, 10 years. But now's the time to fix the next 10 years. Jim Rohn said, you may have to come to grips with reality and with truth. That's what was good for me when I met Mr. Shoaff, who was his mentor. He said, I was 25 years old. He was 44 years old. He brought me the wealth of experience and he started asking me the tough questions. Big question, he said. Are you reading the books that are going to take you where you want to be in the next 5 years? Now, that's a good question. I guess today you'd also be asking, are you listening to the podcasts that are going to get you to where you want to go? Are you reading the blogs? Because to get to where you want to get to in the next 5 years, you're either reading the right books or you're not. You're either listening to the right podcasts or you're not. You're either reading the right blogs or you're not. Either you're engaged in the disciplines or you're not. But here's what you don't want to be engaged in. Disillusion. Hoping without acting. Wishing without doing. The key is to look and say, Where am I? What could I do to make the changes to ensure that I can take more certain daily steps towards the treasure I want? The mental treasure, the personal treasure, the spiritual treasure, the financial treasure. You've got to say, I don't want to make any more errors. Now's the time to adjust my daily program to take me where I want to go. The key is to start right now, start making those changes and to walk this new road. Just a few daily disciplines will make a great deal of difference. And before you know it, you'll be walking a totally new road, just like Jim Rohn did and just like he taught me to do. In a moment, I'm going to have a chat with Pete Wargent about how to invest, how to cope, what to plan for, what to do differently over the next decade in what's going to be a very low interest rate environment. We're going to explain why that's going to occur and what you're going to have to do differently. But before I do, maybe I should mention something else you should consider doing differently. At a time of lower capital growth, a lot of investors are looking to manufacture capital growth by getting involved in renovations or development. By now you've heard me say it often, so I'm not going to say it for too long now, other than to suggest you join me at the end of October at my property renovations and development workshop. Go to realestateworkshop.com.au and find out all about it and join me for 2 days so you can step up to the big league. As I said, you've heard me talk about it before. Why haven't you committed to taking your investment to the next level? You're covered by my personal guarantee, so you've got nothing to lose, but you're going to learn. This is a learning event, not a selling event. It's Australia's longest running advanced property workshop, realestateworkshop.com.au, and find out all about my property renovations and development workshop. And now, let's have a chat with Pete Wargent. Now, the Reserve Bank's cut interest rates in 2 consecutive months this year, in June and July. And they've dropped them to historically low levels. And the money market's factoring 2 more interest rate cuts, one before the year is out and another one in the first half of 2020. And it's likely we're going to have a long period actually of low interest rates moving forward. So what does this mean for property investors? What are the implications for property and for other asset classes and I guess for investors and business people in general? How should you invest in a low inflationary, low interest rate environment? Well, that's what I'm going to chat about today with my regular guest, Pete Wargent. I don't have to give him an introduction. I'm sure you've read his blogs. He's listened to him on my podcast. His blogs on Property Update. But for those of you who don't know him, Pete's a chartered accountant, chartered surveyor, and has a financial planning diploma. So while he's got all the credentials, the most important thing in my mind is he's actually used it personally, using his long-term approach to investing in equities and owning property to achieve financial freedom. And now Pete lives a life of leisure, travelling around the world. Where have I caught you this time, Pete?
I'm actually over in England enjoying some cricket at the moment. Nice time of year to be here in the summer.
And is the cricket working in your favour?
Oh, it's in balance at the moment. So let's see how we go. There's 2 matches left.
Okay. Well, Pete, we're talking about interest rates, but it's not just Australia that's got low interest rates. It's happening all around the world. I guess we're catching up in some ways because rates have been low since the GFC. Why is that happening?
Well, I don't think it's necessarily all that well understood. So I guess the smart aleck answer is it's always supply and demand, which is it's a truism, but that is essentially what drives interest rates around the world. And what we've seen, there's plenty of supply around the world of bonds, but the number of buyers of bonds has just outstripped the supply. So interest rates have just been pushed down and down. And if you're looking for the big structural factors, I guess globally, we've got an aging population, but also there's never been such a high demand from institutions for low risk assets. So historically, there wasn't as much demand. These days, with inflation expected to be low and steady, there are more and more institutions like pension funds and banks and insurance companies and governments and so on. So they're just mopping up these bonds at extremely low rates. Now, everybody likes to try and be smart and say, well, these are the reasons. But it's interesting if you think back. I don't remember people saying 15 years ago that we would have all these interest rates falling close to zero or even negative interest rates in a lot of cases. So while you can explain all these factors, predicting the future is a bit less easy to do than it seems, I suppose.
Interesting. So in the United States, interest rates have dropped to less than 3%. In UK, they're under 2%, even lower in other parts of Europe. I've actually seen recently home loan interest rates with a 2 in front of them in Australia. Pete, I remember when I was excited when my mortgage dropped below 10%. Now, they were in times of higher inflation, higher capital growth. So what do you see? I know you said it's not easy to pull out your crystal ball, but what do you see happening to interest rates, A, in Australia and I guess B, around the world?
So in terms of how what rate you can borrow at as an individual on a mortgage, the prime determinant of that is the overnight cash rate, or the official cash rate that's famously set by the Reserve Bank each month. And usually the best way to predict what's coming is simply to look at market pricing, because that's the consensus view. And it looks like the most likely outcome is we'll probably get one more interest rate cut in 2019, so either October or November. And markets are suggesting probably even one more cut beyond that in the first quarter of 2020. So that takes the official cash rate down to 0.5%, just 0.5%. And in terms of what that means for mortgages, well, as you said, you could be borrowing anywhere from 2.5% upwards. So maybe in the threes for most borrowers. So as you said, that's unprecedented in recent history, and it's going to be very stimulating for housing.
The Reserve Bank in Australia is lowering interest rates because it says it's trying to get employment working better, lowering the unemployment rate to 4.5%, getting inflation up. Currently, unemployment isn't dropping because the participation rate is going up. I recently read that if you take the unemployed and underemployed, because people want more full-time jobs, it's still running at about 13.5%. So do you think the lowering of interest rates are going to end up having the desired effect the RBA wants, Pete?
Eventually, yes. I mean, so that there are more tools that the Reserve Bank can use even beyond cutting the cash rate. So that the more unconventional measures, which is known around the world now as QE, and it's been used by a lot of parts of the world. And if that doesn't work, the government can spend more money. So there are always more levers that can be pulled to get inflation back to that 2 to 3% target. But it may well be that interest rates have to fall pretty close to zero before we start to see that.
Now, interestingly, that's the official interest rates, the RBA rate and the interbank rate, but that's not the rate you and I pay on our home loan or on our investment mortgages. The banks need to pay people something to take deposits in, and they also have to cover their costs, all the offices, the retail, the staff. So as far as I see, they need to charge a margin to cover their overheads, and it seems to be around 2% at least. So what do you think is going to happen to home mortgage rates or investment mortgage rates?
I think it's probably fair to say, even if the Reserve Bank cuts by 50 basis points or 0.5%, if they can get away with it, the banks probably won't pass all of that on. But it's by the same principle. It's all about profit and margin. And our banks have to borrow offshore. So funding costs for our banks have fallen. So that's really good. But they're still going to need to find ways to maintain that margin. So that probably means bad news for savers, as you said. So term deposits will be paying extremely low returns. And they'll probably try to claw some of it back on the mortgage rates as well. But all things being equal, we'd probably expect to see mortgage rates going down by about 0.5% over the next year or so.
Now, I read the other week that in Denmark, one bank announced it would actually pay borrowers, not take money from them, pay borrowers 0.5% to take out a mortgage. I can't see that happening in Australia anytime soon, Pete.
Well, no, I think if you look at the Reserve Bank sees most likely the terminal cash rate would probably stop at about 0.5% before they looked at other measures. I don't think the way Australian banks have their funding composition, I don't think we'll see negative interest rates, but we'll just see very low interest rates. And the way markets are pricing, that could be for a long, long time into the future. So always hard to predict. But if you look at what markets are predicting, well, this could be with us for decades. It's very hard to say.
Now, that's interesting. So what does this mean for property investors, especially those who are borrowing, as most do? As far as I can see, holding costs are going to be lower, Pete, and for many, this is going to make property more affordable. And we know that residential real estate investing is a game of finance, and if you can borrow more, that pushes up property values. I think the negative cash flow drain is going to be less, because what happens to a lot of beginning investors, they borrow 80%. If they buy a high growth property, the rent in the past hasn't covered the mortgage too well, but with mortgage costs being a bit lower, it's going to be easier for them to afford it. That also means there's going to be less negative gearing, because low interest rates significantly reduce the negative gearing tax benefits for property investors. But you should have never bought an investment property for tax reasons. So I can only see it as being positive for property, Pete.
Yeah, you've always found, in fact, historically in Australia, lower interest rates have always been positive for asset prices, and especially housing is very responsive to interest rates. And it's interesting you mentioned the negative gearing aspect, because for something completely different, I did some modelling the other day, and it basically showed that if you follow market pricing for interest rates, and given a few of the other tax changes that have been made to depreciation and travel expenses, well, we had all this hoo-ha during the election about scrapping negative gearing to help balance the budget. But if you actually project it out, by 2021, the savings to be made from negative gearing will be almost nothing anyway, because, as you said, holding costs for investors are just going to keep falling. So I guess in a sense, the government's going after negative gearing as a way to fund other things. Well, it's probably not going to be worth their while, because most investors will be quite close to neutrally geared anyway.
You're right. So some people are wondering, well, is property still going to be a good investment? But in my mind, what's the alternatives? We've already said that cash isn't going to be. Clearly, many investors should have a mixture of shares or managed funds as well, either in their super fund or outside, to give a level of cash flow, especially as you get further down the investment path where you're going to start to lower your loan to value ratios. But in my mind, property investment and leverage is still going to be a very sensible investment, and it doesn't make sense to use your own money, not to borrow, if you could achieve a better investment return with a mortgage. I spoke to a very successful restaurateur yesterday, a client who has given us a very large brief to buy him a block of apartments in Sydney, and he had a large amount of money, many millions of dollars, Pete, and he wasn't going to borrow at all. And I pointed out to him that his borrowing costs, even on a block of apartments where being a commercial mortgage would cost a little bit more, maybe in the order of around 4% for him, but with a capital growth of maybe 4, 5, 6% in Sydney, and even more if we get him a property in a better location, plus the rental return. If the money costs you 4% to get 8, 9, 10% combined return, makes sense, Pete.
Yeah, and I think this is the key point. Lower interest rates are very good for borrowers, but it's very bad news for savers. So if people are looking for return on their money, then the traditional term deposits and corporate bonds, everywhere you look, and on the fixed income side, there's just nothing. They're very, very low returns. So that essentially leaves real estate, so commercial and residential property, and equities. And low interest rates will be positive for those asset classes. As you said, there'll be some assets that perform better than others. And a lot of news at the moment about new apartment blocks and apartment towers, some of them close to the CBDs. Well, I guess that's not what you would call an investment grade asset. So it's still important that you invest in the right thing. And it's really going to be driven by land values, because before this year is out, the population of Australia is going to go blazing past 25.5 million. All of it very, very focused on the capital city. So land prices are going to be the driver for residential property, not so much the high-rise towers with all these building defects. I'd steer clear of those most likely.
Well, I see moving forward there's going to be 2 tiers of apartments. So you're right, our population is growing strongly. They all want to go, in general, to the same 3, 4 places, Melbourne and Sydney in particular, Brisbane, a few less, or southeast Queensland in general. And then they're starting to a little bit go across to the west coast to Perth. But a lot of the my population growth is coming, 60% of it or so is coming from immigration. And many of those people are very comfortable living in apartments. But I can see it'd be a very, very brave investor to buy the new apartments or anything built in the last 10 years because there's too many unknowns. So it really does bring it back to what you were saying, apartments that are built prior to that, what we used to call flats, which were not built out of paper mache. They were built solidly. They had a high land to asset ratio. And I see the next round of apartments being built, Pete, and there will be, and all the problems will work themselves out. But it's going to mean that regulations are going to be stricter. So builders are going to have to be more vigilant. Regulators, town planners, certifiers are going to have to be more careful. Building costs are going to go up. So the next round of construction is going to cost a lot more, pulling up the value of the established properties that I know you and I are personally investing in and recommending to our clients.
Yes, and I think coming back to the low interest rates, well, that generally, it makes it easier for people to pay more for land and sites and so on. The holding costs are much lower. So there's a lot of pressure, upwards pressure on property prices and land values, but it really comes down to owning the right type of assets because the demand is definitely there. And as you said, population in the capital cities, well, it's never really been running as quickly as it is now. Still, even now at the national level, more than 400,000 per annum. That's an awful lot of demand for housing.
Especially if they're all wanting to go to the same place and drive their cars on the same roads where you and I have got our cars. Actually, that's not true. You love living in those areas where there isn't such a population density, Pete.
Oh, look, it depends. We spent most of our, I suppose if you look at your peak earning years, we were young professionals and we like to live in those transport nodes, sort of 10 minutes from the city, with high walkability. I mean, that's where the bulk of demand I see heading to. Now, we're a bit older now and we've got kids and we like to spend time up at Noosa, but you still look at, where most migrants are heading to and where most young professionals want to live. It's generally speaking close to the employment hubs where the opportunities are. The thing you'll be seeing in Melbourne, no doubt, and we've definitely seen in Sydney, is that the traffic is becoming very, very busy. So I think being close to transport connectivity is just becoming more and more important.
Well, the rich don't like to commute. And so they're going to keep living in those sort of areas. And so that's why we like investing in those areas where people have got high disposable income. And it means that those who are not as wealthy get flung further and further out to the outer suburbs. Pete, a couple of other quick things about the low interest rate environment. Is it going to mean that more people are going to be able to buy properties, homes, and there's going to be a smaller letting pool? Or do you think the challenge of finance is still going to be the bottleneck in moving forward?
Yeah, so that's something that's really quite changed a lot since May. So we've been through essentially several years of tightening credit, and the Royal Commission was the zenith of that. Banks became quite reticent to lend. They were quite nervous. It was actually difficult for them to lend, but a number of things have changed. So lower interest rates have already happened since the election, but also from a regulatory perspective, banks were having to use a floor rate of above 7%. So most banks were using 7.25, which I think made sense when it was introduced. But given what we've already said about interest rates, a lot of borrowers might never see 7.25. So now the buffer has been changed to 2.5% above the rate that we borrow at. So it's become much easier, actually, for a lot of borrowers to access finance over the past 6 months or so. Now, there's another thing that's happening on 1 January. So there's a first home buyer deposit scheme. So that's going to bring more first home buyers with 5 or 10% deposits into the market. So the pendulum is now swinging back the other way. So credit is becoming a bit easier to get, just gradually and at the margin. So it's been a tough couple of years for borrowers to get money, but I think generally things are moving back in an easier direction now.
That's going to create some concern for the Reserve Bank because the Reserve Bank doesn't want another property boom. It's wanting a more controlled property market, but it's sort of painted itself in a corner saying it's going to keep dropping interest rates until unemployment rates or dropped to 4.5%. So we've got some interesting times ahead. I guess the message you gave a couple of minutes ago is a good one to finish off on, that correct asset selection is going to be critical. So while lower interest rates may fuel rising property markets, if you can only own 2 or 3 properties, you've really got to own the best properties you can, what I know you and I call investment-grade properties. They're going to remain in continuous strong demand by a wide range of owner-occupiers. Pete, if people want to keep in communication with you, get your daily blogs and your great videos that you put out on a very regular basis, how do they get in contact with you?
Easiest place, just Pete Wargent blog. I do daily content there. And if you want to see a few of the videos as well, it's gonextlevelwealth.com.au.
Fantastic. Look forward to having you back as a regular guest on the Michael Yardney podcast. Thank you, Pete.
Pleasure as always.
Well, as you can see from my chat with Pete Wargent, we both think we're going to have an interesting environment moving ahead. The low interest rate environment will still give investors who know what they're doing, a great opportunity to grow their wealth, while others are going to wonder what's going on. So it is going to be a good time to leverage and gear as long as you own the right sort of assets. And that's what we're going to talk about each week on the Michael Yardney podcast. And if you're getting some benefit from it, may I suggest you help others learn as well. So at the bottom of every podcast app, there's a share button. Tell somebody about it, because the more people we help educate, the less people are going to fall into the traps that the unwary investors have. So my aim is to help you, and I hope your aim is to help others. Let's all pass the message forward. And also, I love it when you say some nice things about the show, and when you do leave a review on iTunes or wherever. And if I read it out, I'd like to say thank you by gifting you one of my books, as I'm going to do to Aaron J. Boyd, who left a great review on Apple Podcasts. Thanks for the 5-star review. And Aaron, who said, humility with honesty. Dear Michael, thanks for presenting your podcast with a great deal of humility on your personal achievements, balanced with a high degree of honesty regarding your own personal journey. Kind regards, Aaron. Well, thank you. That makes me feel even better today. I appreciate that, Aaron. And if you'd like to leave a review and I read it out, just like with Aaron, you email me, michael@metropole.com.au, and I'd love to say thank you back to you by gifting you one of my books. In between these twice weekly podcasts, you can find out a lot more about property, money, success, tax, finance by going to propertyupdate.com.au. And for some of you, I'd love to spend a couple of days with you in October, at the end of October 26th and 27th at the Property Development Workshop. Go to realestateworkshop.com.au, and I look forward to being back with you again real soon for the Michael Yardney podcast. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?